Audio Jungle. Audio Jungle.
Gracias a todos los que van a iniciar desde este momento este recorrido durante 4 días por tantas y tantas experiencias que nos van a ayudar a tener claridades en función no solo de lo que está sucediendo, sino de lo que puede llegar a suceder. Mi nombre es Alonso Castellot, es un gusto y un honor el poder acompañarlos a partir de hoy durante la conferencia, durante todas las diferentes actividades y sobre todo el poder sumar al testimonio. No es el primer año que estoy participando en la Risk and Trading Conference. Muchos de ustedes me habrán escuchado durante muchos años en radio, hasta el 1 de junio de este mes. Pero la primera vez que me piden asistir y hablar de la Risk and Trading Conference, cuando uno está en medio se vuelve uno muy desconfiado. Entonces me puse yo a investigar, bueno, pues quiénes son estos cuates, quiénes vienen a hablar y qué calidad de mensajes tienen. Desde la primera vez que acepté hacerlo, me di cuenta de que no había, porque busqué referentes y busqué comparaciones, y no encontré en Latinoamérica, y en el mundo en general son muy pocos, en Latinoamérica no encontré otro evento con el nivel de expositores que tiene la Risk and Trading Conference, y es algo de lo que hoy me da un enorme orgullo ser parte y el poder acompañarlos durante estos 4 días. Porque además, finalmente, no solo han tomado liderazgo en Latinoamérica, sino también están innovando y están ayudándonos a entender temas tan hostiles como son los riesgos, las matemáticas del día a día de toda institución, de todo intermediario financiero, a poder entenderlo de manera no solamente profunda, sino en función de las tendencias y cómo se va a mover en el mundo para los próximos años. Gracias por estar con nosotros. Bienvenidos.
RiskMathics will play a huge role in that, I'm sure, because, derivative markets have only one way to go as far as, Mexico and Latin America is concerned. You will become key players in the world's derivatives business.
the latest from the
Bien,
best.
pues sin más, quiero invitar a nuestro ponente del día de hoy. Podría dar una larga introducción que todos conocemos, tan larga como la lista de sus libros, tal vez uno de los autores en finanzas más prolíficos que existe. No los inventó, no los creó, pero ¿quién puede negar que cuando piensas en derivados asocias inmediatamente el nombre de los libros de texto, de los libros de referencia que son autoridad en esta disciplina? Mr. John Hall de la Universidad de Toronto, uno de los veteranos, uno de los decanos de este evento. Mr. Hall, bienvenido. Le invito a pasar y lo dejo con su audiencia. Le pido a todos un caluroso aplauso para Mr. John Hall.
Thank you. Well, thank you. It is a real pleasure to be here. The title of my talk is How the Regulation of Financial Institutions is Changing. And you can think of this talk as, as being the first of two breakfast talks at this conference, because Tom Severance is going to be taking off where I leave it and talking about the impact of regulation on the way risk management is done in financial institutions. That's going to be tomorrow morning for those of you who are coming to the breakfast tomorrow. So we have this new program at my business school, the Rotman School in Toronto. It's Master of Financial Risk Management. And we actually graduated the first cohort yesterday. They had the convocation ceremony yesterday. Unfortunately, I missed it. But the course that I teach on MFRM, as we call it, is regulation of financial institutions. It's not, I don't teach derivatives or any of the highly quant stuff. And one of the things I find when you teach regulation is you can't just start where we are now and say, we've got Basel III and Basel IV coming. You've really got to give students the whole history of where, particularly as far as banks are concerned, the whole history of where financial regulation has come from, how it's changed through time, and that sort of thing. So this slide really summarizes about 4 classes that I have on that course, where I trace the history of bank regulation. And you may not be able to read it all right at the back, but we start with pre-1988, where essentially different countries were regulating banks in their own way, and there's variation from country to country. Then we had Basel I, where very simple rules, fairly crude rules in many ways, but they were rules which were very difficult to arbitrage. Then capital for market risk came in, and their banks could develop their own value at risk models, and so on. Then we had a big change with Basel II, because Basel II really said that providing you get permission from your regulator, you can determine your own capital. Lots of scope for internal models. And much more complex rules, too complex in some ways. And the focus was on credit risk and operational risk. The market risk rules didn't change. Then we had the crisis, and of course, a whole slew of regulations since the crisis, Basel 2.5 as it's called, Basel III, and Basel IV. Basel IV, not well defined at the moment, but obviously changes are coming. I think when we look at the history of financial regulation in banks, what we see is, very little use of internal models at first, and then with Basel II, much more use of internal models. And then regulators rethinking that and saying, maybe we've gone too far with internal models, and some sort of pushback post-crisis to make much less use of internal models and maybe use standardized models as a floor for capital. So yeah, you can use an internal model if you want to, but there's a limit to how much it can help you as far as capital is concerned. So if we look at Basel III, which is being implemented during this decade, really, a period reaching up to about 2019, 2020, one important aspect of Basel III is it's not only that banks are required to keep more equity capital, but the actual definition of equity capital has been tightened a lot. And in many ways, it's the tightening of the definition of equity capital that's had more effect than the actual ratios of the amount of equity capital that banks have to keep. Risk-weighted assets, one of the things I have to do on my course, of course, is explain risk-weighted assets, which came in with Basel I, and make sure students are comfortable with RWAs, because we talk about RWAs all the time. But banks are required, of course, to keep much more equity capital as a proportion of risk-weighted assets. And Mark Carney, who used to be governor of the Bank of Canada and, of course, has moved to the Bank of England, has estimated that banks have 7 times as much equity capital per unit of risk-weighted assets than they did pre-crisis. That's huge. 7 times as much. Assume he's right. He may be exaggerating a little bit, but let's suppose banks were earning a return on equity of 14% pre-crisis. And then post-crisis, they do exactly the same thing as they were doing pre-crisis, except they've got 7 times as much equity capital. Then that 14% is going to go down to 2%, which shareholders are unlikely to find acceptable. So it's not surprising that banks are looking for ways of, increasing margins, charging us bank consumers more, and that sort of thing. Another aspect of Basel III, which is kind of interesting, is the leverage ratio requirement, which I'll come back to, but really what the regulators have said is we're uncomfortable with the way things have gone because this risk-weighted assets business, it's a nice idea, but it can be arbitrage to some extent. We want to go back to a very simple measure, which was what we had before 1988, which is the leverage ratio, which is just basically saying we add up all the assets on the balance sheet. Include something for derivatives, but we don't weight the assets according to their credit risk. And we will have a leverage ratio, which is a requirement that banks have to keep. So as things stand right now, there are 2 requirements as far as capital is concerned. One is that you've got to satisfy a ratio as far as risk-weighted assets is concerned, and another is that you've got to satisfy a ratio as far as unrisk-weighted assets are concerned, a leverage ratio. A much simpler ratio, which is more difficult to arbitrage. And then there's a couple of liquidity ratios. The regulators prior to Basel III had not regulated liquidity, and so we've got the liquidity coverage ratio and the net stable funding ratio, which I've summarized. Again, apologies if you can't see all the writing on this slide, but really the liquidity coverage ratio is a short-term ratio, saying if everything goes wrong in the next 30 days, will you survive? And the net stable funding ratio is a longer-term look at the bank and saying, are you matching assets and liabilities well? Because there's always a tendency in banking to have long-term assets funded with short-term liabilities. And if you do too much of that, of course, you're taking a lot of risk. So coming back to the leverage ratio, we've got these two ratios that have to be satisfied now. Used to only be the risk-weighted assets ratio, but so it doesn't take much thinking to think, well, for any given bank, one of these two ratios is going to be the critical ratio at any given time. You're going to be really close to your leverage ratio or really close to your risk-weighted assets ratio. And it's the leverage ratio has been increased. I mean, it was originally proposed to be 3% by the Basel Committee, but it's now 5 to 6% in the US, 4.9% in the UK, 4% in China, and so on. The interesting thing is when you look at US banks and say, well, which of these two ratios is binding? It is actually the leverage ratio that is the binding constraint. In other words, when US banks think about, should we go ahead with this new project? You know, what effect is it going to have on capital? They don't look at what effect it will have on risk-weighted assets. They're fairly comfortable as far as risk-weighted assets is concerned. It's the leverage ratio that is the more of the binding constraint. And that wasn't really what regulators expected. The regulators thought the leverage ratio was going to be something in the background, and the risk-weighted assets ratio was the more binding constraint. So what does that mean? I mean, we know it's more difficult to arbitrage the leverage ratio, but it also may have unintended consequences, because if you're thinking about, well, there's a couple of things we could do. We could sort of do this for relatively safe lending, or we could do this more risky lending. Now, the leverage ratio, both are going to have the same effect on the leverage ratio, because there's no risk-weighted assets as far as the leverage ratio is concerned, but the expected profit from riskier activities is higher. So the leverage ratio may push banks to doing more risky activities. And that's exactly, of course, what the regulators don't want. So that's the unintended consequences problem. So just to summarize what I've been saying, recent trends, I think there's now less reliance. We've been through this cycle, a lot of reliance on internal models, now less reliance on internal models, and uses of standard models to provide a floor for capital, less reliance on risk-weighted assets, collateral and capital are higher, and we've moved to a world where there are multiple regulatory criteria. It used to just be risk-weighted assets. 8% of risk-weighted assets as capital, that was fine. Now we've got actually 4 criteria, because we've got the 2 liquidity ratios, the leverage ratio, and the risk-weighted assets ratio. Used to be when banks were considering, shall we do this? Shall we go ahead with this project? Shall we invest more funds in this area? It was primarily, what's going to be the effect on our capital? What return will we get? But now they've got to think about, well, what's going to be the impact on liquidity as well as capital, and all the different ratios which they have to keep to. Okay, I'd now like to move on to talk a little bit about the derivatives market. Of course, I've been working in derivatives for most of my academic career, and there's been a huge impact on derivative markets since the crisis. We have, of course, 2 different derivative markets, the over-the-counter and exchange-traded, and the dotted line here is representing the size of the exchange-traded market, and the solid line is the over-the-counter market. They're measured in terms of the underlying assets. So as far as the over-the-counter market is concerned, it's the notional principals, and as far as the dotted line is concerned, it's the value of the assets underlying exchange-traded options and futures and that sort of thing. So you see the OTC market's quite a bit bigger. It seems as though recently there's been a decline in the OTC size of the OTC market, but I'm told that's largely a result of compression. Compression is an activity where banks with over-the-counter transactions with each other get together essentially and say we can rationalize these transactions. You know, so there's market participant A, B, and C, and they have transactions with each other, and then they say, well, we can replace these transactions with some new transactions, and the new transactions will have a lower notional principal, and therefore lower capital. So, you know, basically the motivation is to reduce capital. And there's, you know, there's been a lot of motivation to do that, and that's largely why the notional principle underlying OTC transactions has gone down. But we can see that, you know, the OTC market was growing very, very fast until the crisis. And then it's been much, much sort of flatter since then. So, post-crisis, just a little bit post-crisis, the G20 countries met, I think it was in Pittsburgh, in the US, and basically we've got to do something about the OTC market. The OTC market caused the crisis. Now, I think that's probably an unfair conclusion, that the OTC derivatives markets caused the crisis. They certainly played a role in the crisis, but to say that the crisis wouldn't have existed if we didn't have the OTC market is maybe going a little far. But anyway, the regulators in 2009 decided we've got to rein the OTC market in. The OTC market was largely unregulated. And if I maybe phoned you and we agreed to an OTC trade over the phone, telephone call was recorded so we'd know what we've agreed to, that would be a private transaction. We wouldn't have to tell anybody about it. This is pre-crisis. We wouldn't have to tell anybody about it. We could agree to anything we liked, and whether we posted collateral or didn't post collateral, that was up to us, and so on. So all of that changed as a result of international agreements, which were then passed on to the Basel Committee and the Financial Stability Board to implement. So basically what they said in 2009 was OTC derivatives should be traded on electronic platforms or exchanges. So we want more transparency. We want to see what's going on in this market, what the prices are, and so on. They should be cleared through central counterparties, CCPs. I'll say a bit more about that in a minute. And they should be reported to trade repositories. In other words, shouldn't be private transactions that nobody knows about, but they've got to be reported to a central trade repository. And you know, all of these proposals have been implemented in one form or another now. I think the trade repository thing, you may know about the AIG story. Sometime around the middle of September, AIG called the federal government in the US and said, we have a little problem. Lots of collateral calls. We can't meet them. We need to be bailed out. And the key point about that story is that all these transactions which AIG had entered into, which were all one way, they were all, you know, essentially providing insurance against AAA-rated tranches, which proved to be quite risky. All of those, nobody knew about them, except AIG, of course. In other words, it was a big surprise when the federal government got this call saying, we have a little problem. We need a bailout, and the bailout was, I can't remember now, $80 billion, $100 billion cost to the US taxpayer. To be fair to AIG, they did pay it back, but you know, it sort of shook the derivatives world up a bit because this was something that As I say, it was a big surprise. They had no idea that this was going on. And that should not happen again with the use of trade repositories. So central clearing parties have become a key feature of the over-the-counter derivative markets now. And the way it works is the most common over-the-counter derivative transaction is an interest rate swap. And two companies could agree to do an interest rate swap like this. It might be a 5-year deal. One party pays LIBOR, the other pays 5%. Notional principal is specified. And instead of just clearing this between themselves, what they do is they present it to a central clearing party and
Audio Jungle. Audio Jungle.